Salesforce stock is down over 10% after reporting Q3 earnings yesterday after the bell, and it's sitting just above a 52-week low. Is this a good time to start an investment or dollar cost average into Salesforce.com? Talk about that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there. Time to talk about CRM. As you see here on the screen, we are recording this during the regular trade, but right now this stock is down over 10%. That's on the heels of being down over 42% over the last year. We'll certainly keep in mind this company has about $144 billion valuation as we roll through these financials. Now, speaking of those, we had those Q3 numbers. They came out after the bell yesterday. Revenue coming in at $7.84 billion. That was 14% growth year over year, and it beat expectations by about $10 million. They also beat on that non-GAAP EPS side. We'll talk about more about that when we jump into these numbers. On today's show, we'll also look at this from a technical perspective. This is setting up absolutely crystal clear, beautiful from a technical perspective. Now, what we also got yesterday was Q4 outlook. That's the upcoming quarter. Revenue guidance coming in right around $8 billion. The consensus was right there, but this is actually maybe towards the low end of the consensus estimates. I'm seeing now Q4 expecting to be, again, right about $8 billion. The high end, just a shade over that. These companies that have a really like a recurring business model when it comes to billing customers, it's actually pretty predictable from a revenue standpoint. Now, what stands out for me when we look at Salesforce.com is we've got kind of like a high single digits, call it 10% growth rate for the upcoming several quarters, but like a lot of stocks that we're looking at here on the channel, a lot of analysts still haven't pulled back the back half of next year. So we're looking in the back half of 2023. It would be fiscal year 2024 for Salesforce. We're looking in the spring and summertime and into the fall of next year. You're expected to kind of reaccelerate over at this company to kind of a mid double digit or a mid-teens grower really for the foreseeable future, for the next year or two. Can this company do this? Can any other company that we're looking at actually do this? On the revenue side, I think it's going to be a little bit tough. Maybe you have some price increases that get passed through, and obviously they can do that. I think it's possible on the earnings side. You start firing people, you start cutting back on unprofitable projects. I think it's possible on the earnings side. We see strong earnings next year. The revenue side, still a question mark in my opinion. Now, we also got a shocker, according to some analysts, is that co-CEO Brett Taylor actually is departing the company. I actually would categorize this as something that was very much unexpected, as Taylor and co-CEO and founder Marc Benioff had been sharing that position since November of 2021. I actually thought when this announcement got made, I think we even did a video on it, that Taylor was kind of in the succession plans to maybe take over for Marc, who does a lot of charity work and those types of things. So in some ways, I actually think this means Marc's going to stick around, and that means the philosophy with this company when it comes to these financials probably also going to stick around. Now, Dan Ives, who's a Wedbush analyst, thought that this departure was going to mean that Benioff, who's been very aggressive over the year, obviously growing the company through acquisition, it probably means he's going to continue to do that. So when we come over here and look at these financials, we'll keep in mind that there's probably going to be more share dilution when it comes to acquisitions, probably more use of the cash, and we'll discuss that as we move through these financials. So you had your total revenues. Your left-hand column is your most recent quarter. You had about $7.84 billion worth of revenue. Last year, you're at about 6.9. Now, the rub and the complaint that I've always had with this company, and if you come to this channel looking for me to write love letters to all the companies that we look at, well, I tell you what, there's plenty of other financial YouTubers out here that basically just spew love and glorious things about the companies that they review on the channel. We don't do that here because this is not that great, okay? Because of off of $7.8 billion worth of revenue, our total cost of revenue coming in, we'll call that $2.1 billion. This company has fantastic gross margins. So that's what we love about this company. They have gross profit off of 7.8 of about $5.75 billion. Now, the problem I had with this company, the problem I had with Twitter, the problem I have with Square and any Jack Dorsey-led company, and a number of other companies that we look at here on the channel is they chew up all of that gross profit when it comes to operating expenses. So that's R&D, your marketing, and your general and administrative budget. Over the last year, you went from, we'll call that about $5 billion in expenses here, up marginally marginally, okay, not a ton, up to about 5.3. So off of $5.7 billion worth of gross profit, you burn through another $5.3 billion on operating expenses, and you have just $460 million worth of operating profit in a quarter. You stretch it out for the 9-month period, and you see this was a pretty good quarter from an operating perspective, because look, for 9 months, you produced just $673 million of income from operations. The reason why I'm saying only is because you have a $143 billion market cap on this one. So you give this company credit for another quarter where maybe they do $300 million and they get to $1 billion worth of operating profits. Well, yeah, you're paying 140 times operating profits for a company that at best is going to grow kind of at a mid-teens growth rate, and that's probably optimistic. So it's wildly overvalued. I mean, we're talking about, even after being down 10% and after being down 42% over the last year, this company from an operating profit perspective is so wildly overvalued. And yeah, they probably can pull some levers. Yeah, some of these operating expenses is stock-based compensation. It's not actually cash flowing out the building. When we get down to cash flows, we'll see evidence of a little bit of that, not much actually. And on top of that, we've got Marc Benioff likely staying in the seat of this company. This is just going to continue. If you work at Salesforce, it's fantastic. You are well compensated and it's great. You're probably getting $400 lunches like they used to get over at Twitter, but it's terrible for you, the shareholder. It just really is. And this is the type of company, if you are in this type of company, you got to take profits on this, because this is run for the benefits of Marc Benioff, the executives, the employees. It's not really run for the benefit of printing profits for shareholders and analysts. Now, we come down here to cash flows. We pull down a relatively weak net income number primarily due to higher taxes, but also you had a gain on strategic investments last year that was much higher. But you notice for the quarter, $843 million worth of stock-based compensation off of just $210 million worth of net income. So 4 times more stock-based compensation than net income in the most recent quarter. Last year, it was closer to 2 times. Both are just egregiously too much. Now you get to add that back in dollar for dollar over at Salesforce, but take a look. You come down here to net cash provided by operating activities, just $313 million. Last year, it was actually higher at $400 million. You pull down a 9-month number over here at about $4.3 billion. Let's give them credit for a fantastic fourth quarter, which I don't think is going to happen. We'll round this up to about $5 billion of operating cash flow for a full year. Again, we're kind of looking forward here and we're rounding up generously. We've got $5 billion worth of positive cash flow. And again, we've got a company at about $145 billion market cap. You are paying 30 times operating cash flows over at this company. Actually, a number slightly less than that. Again, extraordinarily rich valuation despite the rather massive drop that this company has had from a financial perspective. Everything else in the most recent quarter, they bought back $1.6 billion worth of stock in the last quarter. So they've been buying this stock actually at a level where, they didn't buy it up here at the top. You see here on the financial statement, this was the first buyback that they've done over the last 9 months. So they actually have bought this stock back at not the worst time, which we've seen a lot of companies do over the last year or so. And that $1.6 billion or the $1.7 billion basically offsets your stock-based compensation for the last 2 quarters, but it doesn't offset for the last 9 months. It just offsets it a little bit. When we flow back all the way back up to the balance sheet, this is important with this company because they're not producing a lot of positive cash flow. And if they continue that buyback and if they do any acquisitions that involve cash, well, you're going to burn through a lot of this cash at some point, but nothing to be too alarmed with. You've got well over $11.8 billion worth of cash. You got about $1.2 billion worth of debt that is due soon. Some longer term debt here, but nothing from a balance sheet that would really have me super alarmed. The problem we've always had with Salesforce is they don't print very large operating profits, and they actually don't print a lot of cash flow either. It's always like the hope that it comes and it just never does. And I think with Marc Benioff likely in the head of this company, probably still isn't going to be there. Now, from a technical perspective, this is a thing of beauty. We've been in a long-term uptrend. I'll trade this red line for a purple line, and we've been in a decade-long uptrend. And you notice, folks, every time we've dipped back to this purple line, it's actually been a fantastic area to accumulate Salesforce.com. So I tell you what, if you're comfortable with paying 30 times operating cash flows, like 140 times operating profits for a company like this, well, I tell you what, this is the time to accumulate the shares. I know we're in just this gigantic steep downtrend, but these are going to end at some point. They're not going to like come back. We're not going to have like this V-shaped slam back to the top, but my guess is we'll probably slowly churn back up this purple line if this trend continues to hold with Salesforce. And I tell you what, this trend has been intact a lot longer than a decade. I mean, we're talking nearly a 2-decade long uptrend with this stock. So who am I to get on here and say that this will end? This would be the area, again, if you're comfortable with paying for this stock, it doesn't pay a dividend, has a relatively small buyback that just doesn't even offset the stock-based compensation. This is an area where you step in and buy this one. I would argue, though, in this sector, there's probably better stocks that have larger buybacks, that have actually a dividend payment as well, and a valuation that makes a little bit more sense. Again, here on the Investor Channel, we don't write love letters to all the stocks that we cover. We give it to you straight, give it to you from my perspective, but I'd love to hear yours down in the comments below. But until the next video, we'll see you again soon. Good luck with your investments.